Welcome back to the second episode of model construction. And before we get into it, having to get my wisdom teeth removed tomorrow, it's really made me think about how important my model is to me and how it eliminates all of my FOMO. I know that when I'm back, it's going to present itself. My model is going to be there. I'm going to make money when I'm back. And if you could think about it, what would you feel like every day, every week, every weekend, if you knew that your model was going to present itself? How would your trading change? What would you do? What would you try and force and what would you not force? Would you only stick to that model and stick to A+ setups? And that's the real key to trading. Eliminating every single urge to trade outside of that model, to do something that's unwarranted, to over leverage instead of letting time do the heavy lifting. And knowing what time that model presents itself is the most important. What time are you supposed to trade it? When does it work? When does it fail? All of those things are found backtesting, but we have to know what to backtest first. So let's take a look at that. That brings us into time. Now, time is the absolute most important aspect inside of your trading. When is something going to occur? How do you choose the correct liquidity? How do you know that that fair value gap is going to play out at that specific time? Now, the very first thing I do when I'm going into a trading day is I mark out the liquidity. And the first liquidity I look for is that overnight session, that London session liquidity. And that's going to be 2 a.m. to 5 a.m. Now, ICT taught that inside of his One Setup for Life video, but I found that when I trade using 1 a.m, I get very precise exits. So I like to look at it from 1 a.m. to 5 a.m. When we look at AM session, 9:30 to noon, 12 o'clock p.m., we want to make sure that these liquidity pools align with the high time frame draw. And we're going to look at examples of that to see how those all combine together to make high probability setups. Without that bias, you're going to just simply be gambling. Lunch. Lunch is most likely going to raid an AM session low-hanging fruit objective. And if we have a strong close at the end of the day, where PM session, 1:30 to 4 p.m., creates relative equal lows with lunch, then I'm going to expect an overnight Asia session or London session to trade down into those lows, which is most of the times is a high time frame PDRA, high time frame fair value gap, which sets up Cairo, and then start moving higher from there. So when we're already able to look at when these things occur and how they occur, your framework for your trades is crystal clear. If I'm looking to take a reversal trade, are we trading during lunch? No? Well, then if AM session has been rallying the entire time, I'm not going to try and be taking a short at 2 p.m. Unless it's a market maker sell model, then obviously all of those things are different. But when we now look at macros are so overpowered. But some people in the trading space will like to say that they don't work. Macros don't exist, they don't work, and all of those people don't know what they're talking about. All of the macros are the last 10 minutes to first 10 minutes of every single hour, unless it's 3 o'clock, power hour. For example, 9:50 to 10:10. The X's are simply placeholders. 9:50 to 10:10 is the first AM session macro. 10:50 to 11:10, which I love trading that macro. It's called the last ditch macro. If that AM session hasn't really done that much, if it's been kind of a consolidation or back and forth high resistant, that macro is when I'm looking for something to occur. And if you go back into your old charts and backtest that, you're going to see that's when price is going to give up the ghost and make a really good run. And if that doesn't, then you know the PM session is going to be really good. So combining all of those things, you already have a setup for high probability trading. That brings us into today's example of how price is being delivered on the basis of time. So we have high probability relative equal lows between the London session from Monday, using that 1 o'clock, and PM session lows from yesterday, Tuesday. All of those things we're adding together to create a high probability draw that aligns with the daily and the weekly chart being bearish. So at 9:30, we have price move lower, creates first presented, inverses, trades to the opening range gap low. Does price continue higher or fail? It fails. So price trades lower, trades back up, and then gives up. We reclaim first presented fair value gap. Now, in the best scenario, we're not going to see that upper portion of first presented here be traded to. However, because it's the day after a large range, which just like the first video, we expect, consolidation. We have a good move here, but inside of this, that's what we expect. We expect back and forth price action like that. So at 9:50, the macro starts. What starts occurring? Price begins to spool lower, reclaims first presented, trades up, and then gives up the ghost lower. Macro ends at 10:10 right there. Now, just a little gem for you guys. If SMT occurs before the macro or inside of the macro, that's going to be a rocket fuel for price. You're going to see price just have a great run. And that's what I'd love to look for. But inside of here, when I'm looking for a Cairo, we have a 5-minute SIBI now. And I want to see, is price willing to have a continuation? Well, it trades up here, drops, does not close below. I was looking for that inversion. It didn't come. That's fine. We have to wait and be patient. Trades up here, back into first presented fair value gap. But look at those bodies. It's staying underneath the consequential encroachment. Price drops lower, inverses that 1007 BISI, trades back up higher, touches right to that low. And what starts occurring? Right at the time of our macro, our last ditch macro for that AM session to really spool price lower occurs here. We reclaim it, 950 wicks up, 1053, wicks up, 1055 wicks up, and then one last time at 1059. See how those wicks are going lower and lower and lower, and the bodies are outside? That last time you see it occur there, which is that daily wick low, because wicks are gaps, so it trades to that wick low, and then it starts moving lower. Trades below this 1058 candlestick. There's your order block right there. Bearish order block. See how it's used there? And as soon as that candle trades one tick below that opening price, that's the change in the state of delivery. It wicks up at 1101 there, creates relative equal lows with that sell side liquidity, high time frame, trades up to it there, trades up to it there, and then drops. But what time is the entry setting up for you? Where is the high probability entry occurring? Again, it's during the macro. The macro is all about how you're going to use it to spool price lower, the list of directives that's being given to the algorithm to spool price. There. That high probability is what we want to focus on. So for this AM session, what are the two high probability entries that are given? 950 to 1010, and then 1050 to 1110. So right there, when you backtest like that, that's going to give you undeniable proof that macros are real, price works off of them, and even if they don't set something up, if they consolidate and they create an SMT during that macro, then what happens after that? There's something for you to backtest too. All of those things are so good, and they're going to help you so much. Now, what we also need to look at is up here, that opening range gap. Time, yesterday's settlement to today's open. How is it being traded to there? People love to look at what's being traded to and what's being respected. But leading right into narrative is what's not being traded to. How weak is something? So let's take a look at that right now. And now that brings us into narrative. And narrative is not simply your bias. It's about how the market is going to fulfill the expectations of your bias. It's about understanding the sequence of events that are going to transpire and the reason behind the moves. Narrative is before bias because it's needed to understand that if you're sitting down 5 minutes before market open and you have absolutely no expectation of what price is going to do and what it should do, you're gambling. And that's what you have to anticipate, not react. Our job is to predict the market. That's the whole point of a trade. You're saying price is likely to go here, so I'm setting my price target here. You're predicting that. If you're reacting to price, you're going to be late. You're going to be chasing that move because it's already happened. So understanding the narrative of what's occurring is this example here. It trades up. It doesn't trade to that opening range gap high. Is that showing you that it's strong, or is it showing you that it's super weak, that it can't even trade to 50% of the opening range gap? Well, that's clear. It's super, super weak. So you may know what order blocks are or what fair value gaps are, but if you're not grasping the underlying reason, the underlying story of why price should trade to a certain level at a specific time, like inside of here, then you're not going to be able to confidently hold a trade. Why is what's occurring? If we're bullish, why do we want to see a run on sell side first? What's the narrative behind that? Well, because if we're bullish and everyone is long, including retail, well, we want those people to be stopped out. So order pairing can occur, that liquidity can be taken. Everyone who's long is stopped out of their position. When price starts running, they're going to chase that price. When they're chasing that price, you can sell your position off to them. If they're too afraid to enter, then they're going to miss the move, and then eventually they're going to want to re-enter that long. Shorts are going to be in profit. They're going to set their stop losses above those highs, and then you're going to attack those highs. All of that narrative that's occurring on inside of the marketplace is really, really essential to understand how you're going to hold the trade, why you're going to hold the trade. How can you be confident that price is going to do what it's supposed to do? For me, I couldn't ever hold my trades when I first started. But when I was able to confidently understand what was occurring inside of the market and why it was occurring, then the whole new world opened up. Because inside of here, I'm able to say, okay, here at 1040, what do we have coming up? Okay, we have the macro coming up. What got traded to at that 1041 candlestick? Look. What got traded to? Just the low? Not even the lower quadrant, not even the lower eighth. Where's this body stopping right there? Why is it stopping there? Oh, okay. So now I have everything telling me that it's super weak. Where is that trading to up here? The upper eighth. Price is trading lower now. Oh, it's trading lower? Well, that was bearish. That was bearish. And we're super bearish here because we failed up here. So what is expected to transpire? Okay, well then that's simple. We're expecting now bearish price action to trade down to here. Now, yes, premium discount and all of that, but even if you just want a bread and butter setup like that, there's nothing wrong with that. There's absolutely nothing wrong with having a bread and butter, a base hit setup that you can take like that. And if you have a job, if you have priorities to take care of, okay, well, I have a lunch break. That's the only time I can watch price and I can trade. Okay, well, looks like I have to trade that. So how am I going to make my model based around lunch? That's the key. Right now, maybe you can't trade AM session. But right now, you can trade London. Well, you're going to have to trade London. It's not going to be perfect for you right now, but in the future it will be. And it starts with this. It starts with developing a model that you're going to stick to, that you're going to trade until, let's say, you can trade AM session because you were profitable for 3 years trading London. You understand price action. You saved up a bunch of money, and now you quit your job and you can finally trade AM session. Price is price. The same thing's going to occur. But what's important is you develop that model, you develop that confidence on the basis of time, and you submit to that time to do the heavy lifting for you. I don't know when the next video is going to come out because of these wisdom teeth getting removed. I may be able to finish the series tonight, but I'm not sure at all. So in the meantime, you need to identify these things so far that we've talked about. Inside of my journals, I have pages of pages of pages of every single model that I have and every single model that I use in extreme detail. All of that. For everything. And what I just showed really has no real importance besides showing the effort that goes into it. These are very basic models that I created around 2 years ago for myself. And they are just constant. They're always going to be the same exact things that I look for inside of the marketplace, and they're never going to change. These things are extremely valuable to me. I've brought them on very important meetings that I've had to go to, and having those things, knowing they perform, backtesting it, is really the key to your success. So until next time, be safe and God bless.